Thank you for taking the time out of your busy schedule today to join our webinar. We'll be answering all your tax and investment questions. So the presentation will begin shortly, and I'll be the moderator of the webinar alongside our guest speakers, who I'll be introducing shortly. We'll be putting everybody on mute as soon as the presentation begins. Please feel free to ask any questions in the chat, and we'll do our best to answer them for you or interrupt the speakers to get their thoughts on the matter. And just before we start, a few disclaimers to go through for compliance, so just bear with me. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. So let me introduce first our guest speaker. We have Shannon Meyer with us. He's a licensed CPA with 22 years of experience in U.S. entity and individual taxation, specializing in international tax reporting and planning for citizens, U.S. citizens residing abroad and foreign nationals working in the U.S.
Hello, nice to meet everyone.
Brilliant. Thanks, Bailey. Great to see you, Shannon. We're now making the tour of Europe, which is a lot of fun. You've survived tax season, so congratulations for getting past May 17th. And
yeah, it's excited to be past it.
But now you get the whole expat crowd because a lot of us haven't done our taxes.
Yeah, now on to June 15th.
Exactly. We'll go from one filing to the next filing to the next. I'm going to ask everybody, let's make this as interactive, as fun as possible. For most of us, sorry, Shannon, taxes aren't the most interesting subject matter. So feel free to pop any of your questions in the notes. We're just going to have a conversation here at first talking about Dutch taxes, but then we're going to dig into all the Q&As from there. So feel free to ask them while we're going, and we might even ask you to unmute yourself so that we can have an interaction with the crowd. So why don't we just dig right in? So first of all, what are the most important things that we should know about Dutch taxes, the 30% ruling and such?
Yeah, so the 30% ruling is certainly a big one if you've got it. And effectively what that is you just kind of get the hair cut off the top 30% of your income from Dutch taxation, but that only affects your Dutch taxation. So for US purposes, your full income is still going to be taxable. But the benefit that gives is the Dutch rate's generally higher than the US rate. So if you haircut off that 30% and to exclude it from Dutch taxation, that gets you down, and it kind of depends on a lot of factors, but a lot of times you may not still be subject to residual US tax.
I love that you're the eternal optimist, and that's the benefit, is that you pay more taxes in the Netherlands. I hear what you're saying. I see what you're saying. We'll see if that changes a little bit with some of these Biden tax changes, but we'll get back to that. So we have that 30% ruling that essentially people can get into for a certain period of time, and then it might come off. But if you don't have the 30% ruling, you're probably subject to something that's a little bit different than what we're used to in the United States, which is the wealth tax. Do you want to dig in a little bit into the wealth tax?
Yeah, so the wealth tax is basically, in the US, we're subject to capital gains tax on our appreciation and our assets and investments. So, I'm sure you're all aware of it, but when you sell a stock or a security, you look at what the market value of that is at the time that you sell it versus when you originally paid for it, and you pay a gain or a tax on that gain at the time you sell it. In the Netherlands, they also have a wealth tax where you essentially at each year look at the average value of your assets worldwide, and then you pay a tax on that. For US purposes, that is not a creditable tax. So, if I recognize capital gain income in the US, for example, or just wages earnings, I can take a credit against that on my US return for income taxes paid to the Netherlands. But the wealth tax is not considered a income tax under the IRS code. So instead of claiming a credit, that gets claimed as a deduction on your return, which is generally not as favorable as a credit.
So in other words, we can't offset it perfectly. from
Nope,
one way
nope.
to the other.
Correct. It's not an offset.
Well, we can't win every single one in that regard. Now, you said earlier, for the most part, most Americans in the Netherlands don't end up paying tax. So can you dig a little bit deeper with those credit systems and the FEIE? First of all, could you define the FEIE versus the credit systems, and then dig deeper into that?
Okay, yeah. So basic concept is the U.S. One of the joys of being a U.S. citizen is we're taxed on our worldwide income, no matter where you live at. To avoid double taxation, the IRS gives us two tools. One's the foreign earned income exclusion, and then the other is foreign tax credits. And what the foreign earned income exclusion is, in simple terms, is to the extent I have foreign earned wages, and this is wages when we source income or talk about where it's sourced to, it's based upon where the services are physically being performed at. It doesn't matter where your contract is with or where you're paid from. So even if you're working for a US company, but if you're living and working in the Netherlands, that's foreign sourced income that you can claim the foreign exclusion against. Effectively, you can exclude up to, the number changes each year with inflation, but it's about $100,000 of foreign earned wages. If your
inflation's moved up, so we're now at 107,000, which
yeah
is
so
it
progressively jumps up every year. So
exactly.
And now in conjunction with that is foreign tax credit. So let's say you're earning 200,000 a year. Well, I've only excluded 107,000 of my income off of this foreign earned income exclusion. That leaves another 93,000 that's taxable for U.S. purposes. On this portion, you can claim foreign tax credits, which is I'm on my U.S. return, I'm claiming against my U.S. tax a credit for taxes paid to the Netherlands. And these two work in conjunction with each other. So and all the options on what you do is kind of your decision when you file your tax return. If you don't have to claim the exclusion if you don't want to, and you can take foreign tax credits on the whole portion. That generally is a pretty good planning option if you're in a high tax country, because then you can build up excess foreign tax credits that you can carry forward and use in later years. If you're in a low tax country, that's going to be a lower rate than the U.S., then the exclusion probably gives you a better answer. If you do claim the exclusion, though, one kind of wrinkle with exclusion is if I exclude income, I also exclude the foreign taxes paid on that income. So they don't let you double dip.
And just to be clear, you do consider the Netherlands a high tax country?
Yeah. Generally, you're looking at anything that it has a higher rate in the U.S. and all of Europe pretty much wins that award.
Yeah, that's for sure. Now on those foreign credits, sometimes there's benefits longer term for pensions, because a lot of people are going to have a corporate pension that they're going to have the option to receive in the Netherlands, and sometimes they're quite attractive. They actually have a great system in the Netherlands of aggregating all of those. So are there advantages and disadvantages on the tax side of when you should take a pension, or how you should do your taxes for those pensions?
Yeah, so and we'll distinguish, corporate pension versus like government Social Security. Government Social Securities are generally always, and this is even under the income tax treaty between countries, government Social Securities are generally taxable in the country that they're from. So the Netherlands is going to continue to tax their government Social Security no matter where you're living at when it's paid out. Company pensions are typically, and it varies from treaty to treaty depending upon the country combination, but typically pensions are taxable in the country of residence at the time of distribution. So even though you may have grown and accumulated your pension while working in the Netherlands, if you retire in the US or any other country, a lot of times that pension is going to be taxed in the country of residence at the time of distribution. That gives you some planning opportunities. So one consideration from the US is if so I mentioned if you've paid excess foreign tax credits. So the way you calculate your credits is each year the usable credit is based upon the US income tax. So let's say I make $100,000 of income. in this example, I'm not going to claim any exclusion. Let's say I paid $30,000 of Netherlands tax on that income, and $20,000 would be my equivalent US tax on that 100,000 of income. I'm going to use $20,000 of that foreign tax credit to offset my calculated US tax. That remaining $10,000 carries forward into future years, and it can carry forward up to 10 years. And if not used within 10 years, it expires. But somebody that might be approaching retirement, what you can do is if you build up that excess credit, and then when you retire, let's say you move out of the Netherlands, and we'll say you retire back in the US, you take that distribution from your pension while you're a US resident. The Netherlands isn't going to tax it because you're not residing in the Netherlands anymore. US is still going to tax it because you're a US citizen. But I can still, since that pension was earned while I was working in the Netherlands, I can still consider it foreign sourced income and use my foreign tax credit carry forward against it. Effectively may let me get out of a lot of or tax either partially or entirely on that pension distribution.
It's a brilliant longer term strategy. Sorry, did I interrupt you there?
Yeah, well, and I was going to say, there's a similar strategy that you can do with the exclusion as well that kind of accomplishes the same thing, but works a little bit different. So if I was claiming the foreign earned income exclusion, a lot of times pensions, again, the tax treaty may allow pensions to be, a contributions into a Dutch pension to be exempt from US income as well. But if I have enough cushion in my foreign earned income exclusion, you may not want to take that pension or that pension exemption. So again, if our exclusion is only is up to 107,000, if I'm only making $80,000 of income and I have a $10,000 of pension contributions that either I make or maybe the company makes on my behalf, if you don't take a deduction for that for US purposes, I recognize the income for US, so I'm now recognizing 90,000 of income instead of 80,000, but it's still under my exclusion. So I can exclude all of that income and I don't pay any US tax on it. The benefit it gives me is if I didn't take a deduction when the money went in, or if I've already taxed any company contributions into my pension, I have basis in those contributions. So in retirement, when I take that distribution, I'm now not going to be taxed on that income a second time because I used after-tax money when it went in. So again, that's kind of another planning opportunity that's pretty simple. If you are taking the exclusion and you've got plenty of extra exclusion room, you might not think about not taking a deduction on those pensions and just build up basis in them.
Brilliant. I don't know if I could repeat that 3 times fast, but might have to watch the recording again. We've got a great question in the chat. That's a perfect follow-up to that. How do you keep records of that carryover credit?
So that on the foreign tax credit, that carryover credit generally gets tracked in your tax return. So it depends a little bit on like the preparation software that you're using. But most of the softwares I've ever used will roll forward a carry forward schedule showing how much remaining credit that you have. The foreign earned income or the reduction of credits for foreign excluded income though. So that's the piece where if I am claiming the foreign earned income exclusion and I exclude some income, I also exclude some credit. That calculation you kind of have to really watch in softwares because like a TurboTax generally doesn't calculate that automatically. You have to hand calculate some of that stuff. Your higher end professional preparation softwares may do it automatically, but those are generally pretty expensive for an individual. So, but generally that credit will be monitored and rolled forward in your software. If it doesn't do that, then I would just keep like an Excel spreadsheet schedule that each year from the form 1116, you can see how much unused credit you have, and you just kind of keep track of that.
Yeah, I'm sure if they hired you to take care of their taxes, that you'd be keeping track of that. So that's the real short answer of it.
Yeah. The short answer is I watch all of that for you.
Brilliant. Well, as we're going off the pensions, naturally, we were always going to encourage people to invest in their local pensions and make sure that they take the tax advantages for that. But there might be extra money that you might be investing for other purposes or for your retirement. What are your views on local investments that might be considered PFICs, passive foreign investment companies?
Yeah, that is an evil word, so avoid it if all possible. So a passive foreign investment company, or a PFIC, the concept of why they originally created this legislation was to prevent, and really their target was, people sitting in the U.S., U.S. citizens sitting in the U.S. That would establish a company outside the U.S. in a tax-free jurisdiction, put their assets, their investment assets in that company, and do their investing from there, trying to shelter it from individual taxation in the US because it's actually being subject to corporate taxation sitting outside. That was kind of the original premise that the government was trying to avoid. So they created these PFIC rules. And effectively what it is if like 75% or more of the investments of that foreign company is investments in other companies, then it falls into this PFIC rule, then it's a very unfavorable tax treatment for the US. Effectively, you get taxed at the top possible marginal rate, and you have to pay this interest charge for each year that the income got deferred. So if you set the account up 10 years ago and you take a distribution now, you get charged a 7% interest rate for all 10 years. Very, very unfavorable tax treatment. Well, the problem is and most people may think that said, well, I'm not doing that, so that won't bother me. But what falls under these rules is foreign mutual funds. So, and it could be just a publicly traded mutual fund like a CCAV, but it still meets the IRS's definition of it's a company formed outside the US that invests in other companies. And that's generally what mutual funds are. So, I highly suggest against investing in European mutual funds. If you want to hold those funds, you can certainly do that. You just do it through your US brokerage account. I mean, if you're working through US brokerage, you can find all the foreign investments that you want in that US brokerage, and that kind of shifts all that burdensome broker reporting and tax treatment over to the brokerage company. You get a nice clean 1099 for US purposes, and you get ordinary US treatment.
Brilliant. The only thing that I'd add on there is that exchange traded funds that are on foreign exchanges are also considered inside of that PFIC bracket. So, and that's to where you should buy them all on the US exchanges and take care of them.
Yeah, because the other thing you want to watch out for, even if you're holding, holding a direct stock company investment, so I own stock in a operating company, that's not as bad because you don't get the PFIC treatment.
Right.
But you still have to deal with currency exchange gain issues, because when I'm converting my gain, I'm not looking at just the true gain or loss in the value of that stock. I'm also looking at the change in the exchange rates between the US dollar and the euro from when I bought it and sold it. So again, if you kind of have done everything through a US brokerage account, you'll avoid the exchange rate risk and exposure as well.
Absolutely. Great points. And for everybody on this call, just in case you start worrying about, well, none of the US brokerage accounts will take us on board, we do have a solution for you. And we do have a no minimum solution, low fee solution for you, as well as our financial planning solution. But today is not about that. Today is all about taxes. So I'll divert from that commercial right there to go back to that tax segment on that. Now, we talked about the pensions, and then we talked about PFICs. Are those funds that are naturally not US funds considered PFICs when they're owned inside of a foreign pension?
This is where you want to get, how technical do you want to get versus the practical?
Absolutely. That's digging into the details.
Yeah, I would say, like, if you want to get super technical, you can have some exposure of a PFIC sitting inside of a pension account. I know, at least from my perspective, and this is what we'd kind of done at Deloitte when I was previously with Deloitte, and we generally kind of didn't dive into that side of it. So if it was inside of a pension account, we kind of viewed the overall pension as qualified for U.S. purposes under the tax treaty, and took a deferral treatment on it. If you can avoid buying PFICs inside of your pension, I would suggest doing that, not to create some unnecessary exposure. But it wasn't generally something that I still kind of hold a blind eye to it a little bit.
Well, the good news is, see, the UK and Canada end up being the best places for double taxation treaties, and we get hints of how the rest of the world should be determined. And I think it was 2016, the IRS basically deemed the UK pension didn't fall into that PFIC line. That doesn't mean that it works for the Netherlands, but it sets some sort of precedence, which common law should be based on precedence. So
yeah, and Canada has done that as well. Canada is kind of, with the RSPs, you would think that we're right next to each other, we'd cooperate. They do on some, but not other stuff. But they have kind of come out and specifically exempted some of the Canadian pensions for U.S. purposes. So and it goes back to that point to say, well, yeah, they're kind of viewing it as a pension, being a separate thing than like an investment PFIC. So
absolutely, we've got some follow-up questions here over in the chat. The first one's from Albert. Does direct purchase of a company bond subject you to the PFIC treatment? Now, Albert, I'm going to actually ask you, are you talking about a fixed income bond, which is how we're talking about it on the US vantage point, or are you talking about a portfolio bond, which would be more of the European context with underlying investments? So I'm going to ask you for a follow-up, for you to follow up on that. Fixed income, I believe. Perfect. Thank you, Albert. So now I'll pass that on to you, Shannon, as the question.
Well, and Brian's going in the right spot. Fixed income, you should be okay. So if I'm like just buying a direct bond, a single bond that pays an interest rate on it, you should be okay with that. It's a foreign asset that you're going to have to disclose, but you wouldn't likely fall into the PFIC treatment. Now, if you buy a portfolio holding, or like this is a bond that holds a bunch of different stuff, again, that's when you start falling into those PFIC rules.
Perfect. Yeah, I'm looking at the website that Albert sent. It looks like just a private placement bond, so it shouldn't have any PFIC issues on that regard. And we actually will have sometimes foreign bonds inside of our portfolio, so it's absolutely no problem. Oh, well, I could not have asked for a better segue, so thank you, Lisa. This is a perfect question. How does the Dutch tax system tax the US investments, retirement funds, such as Roth IRAs and IRAs? First of all, can you define what an IRA is and a Roth IRA is for everybody that might not be aware of it?
Yeah, so an IRA, or you'll also hear it referred to as a traditional IRA, functions basically the exact same as like a 401k plan that people may have had. Difference between a 401k is that's generally administered through a company. IRA is something that I hold on my own personal basis. An IRA, so traditional IRA, when I put money into it, I get a tax deduction up front. The money grows in that account tax-free. And then when I take it out of, when I take a distribution in retirement, and that generally has to be at least after age 59 and a half, I pay tax on the distribution. A Roth is basically the exact opposite. So when I put money into a Roth up front, there's no deduction. It grows tax-free. But then when I take a distribution from the Roth in retirement, there's no taxation at distribution. So the decision between the two really all comes down to what is my tax rate now versus what I expect my tax rate to be in retirement. If I'm in a higher tax rate now than I anticipate at retirement, a traditional IRA is going to be better because I get the tax deduction up front at the higher rate. And if you sit down and go through the math, even if I get taxed on my earnings and everything else later on, it's still better to take the distribution up front if I'm currently in a higher tax rate. If I'm in a lower tax rate now and I expect to be in a higher tax rate in retirement, then a Roth is going to be a better distribution. Now, this is thinking from a US tax perspective. So one consideration is You know, if you're living overseas and you're not really paying any US tax now, deductions from a traditional IRA likely don't give you any benefit. So a Roth is probably going to be a better scenario. And even to take that a step further, a planning opportunity is if you have existing IRA accounts, you can roll those over into a Roth and basically to shelter any future taxation, but it's a taxable event when you roll it over. So basically at the date, you don't pay the 10% early distribution penalty, but just the balance that you roll over all gets treated as taxable income, whatever amount that you roll over. So an opportunity is, you know, let's go back to the example of somebody earning $80,000 of income a year. Well, if I'm earning $80,000 of wages, and let's say I don't have any sources of other income, my $80,000 of income is going to get offset by the foreign earned income exclusion. That leaves me my standard deduction or itemized deduction, depending upon the scenario, to offset against other sources of income. So I could potentially, on an annual basis, convert part of my IRA account into a Roth. I'm intentionally generating income, but if I keep that under my amount of annual standard deduction, I recognize income, use that standard deduction to offset it. I still don't pay any US tax currently, but I've now gotten my IRA from a taxable account to a future non-taxable account.
Brilliant. I love it. So making new contributions each year. Can an expat in the Netherlands make that contribution? And you know the next question is going to be, should they?
So that yes, you can make the contribution, and probably to step back, we were kind of talking only from a US perspective. Now what's the Dutch tax treatment of that? I don't remember right offhand if the Netherlands, if you took a distribution from your IRA, you're likely going to be taxable on that distribution. I don't believe you'll be taxable on the current annual earnings of that IRA account. It's going to be protected under the tax treaty, I believe, but don't
exactly. No, you're
that.
Completely correct. You're not going to be taxed on the growth of, because they consider it an outside pension, but the distribution, they don't have a separate categorization on it, so therefore they're going to be taxing it.
Okay. Yeah, but it may fall under the wealth tax.
Mm-hmm.
Unless pensions are exempted on that wealth tax.
Pensions are exempt. Yes, pensions are exempt, so I don't believe they will.
Okay. Okay. So then from a Dutch perspective, it's still going to be pretty clean. So now making annual contributions, again, I think it would make sense to continue to fund that IRA. It's going to be best if you're under the income threshold to be eligible for a Roth. It's going to be best to do Roth contributions. Because again, if I'm already excluding all of my income for US purposes, or if I have enough foreign tax credit that I don't pay any residual US tax, I just as well put the money straight into a Roth and get the future tax-free treatment. If you're not eligible to do a direct Roth contribution, because they do have a limitation based upon your adjusted gross income, then the route to go is to make a non-deductible traditional IRA contribution. And then you can look at doing a conversion rollover, basically where you convert it from a traditional Roth over to or from a traditional IRA over to a Roth, because there is no income limitation on doing that.
Brilliant. And to add to that, I posted in the chat box, we did a full hour session, Anya, our financial planner, just on IRAs and just on that subject matter. So I know we don't have time to only cover that today. So we did put that in there, and that is extremely helpful. We got some more questions in here. Nick says, are there any Dutch retirement account providers, administrators whose portfolios don't contain PFICs? Well, yes, there's some of the different providers that do. The problem right now is minimums and such with a lot of those. The Dutch system's a little bit more pragmatic, and I would expect on universal pension rules that they can go across Europe that will get more competitive groups over there. But as Shannon was saying earlier, at this point in time, we haven't seen anybody that has had problems with having PFICs inside of a pension. So it's only outside of the pension that I'd be really concerned about it, and that I'd be thinking about how to maneuver that around. Okay, we have another question. For a US person owning a US rental property, I understand that this is included in box 3, but then deducted under the treaty, leaving a tiny rate differential. But if you own a US property as a second home vacation and never rent it out, it's not on the Schedule E. Is that eligible for the box 3 deduction under the treaty, since it isn't being subjected to US tax? This almost might be something, unless Shannon, you want to dig into this, this almost might be something that we want to have the Dutch tax accountant answer it.
Yeah, that might be a good follow-up response.
So we don't want to dig into things that are not our specialties, and Dutch tax is not the specialty. American tax is Shannon's specialty. But on subsequent episodes, as you're probably aware, this is a 3-monthly program. We will have a Dutch accountant, and that will be the perfect question there. So sorry about that. Does the Dutch tax system recognize the Roth IRA and pension fund? So they recognize it as a pension fund. They're not going to recognize it as a tax-free reduction. So this is to where you need to think about some of your financial planning longer term. Now, is it better to be in a Roth IRA than a traditional IRA if you don't know where you're going to end up? Absolutely. But if you end up in a lot of countries, they'll consider the distributions, if it's taxable in that country, the same way, whether it's a Roth or a traditional. So does it become more advantageous? No, it's just one extra piece of admin to take that out. So if you're in the Netherlands for a period of time, you're definitely moving back to the US, that is the strategy to go to, because you're able to go ahead and get that money over into a Roth IRA. It doesn't cost you anything. If you're definitely retiring in the Netherlands, I still think it's a better strategy than leaving it in the traditional, because again, like Shannon was saying, it ends up not costing you anything. And what we have noticed is that these tax treaties, they do get renegotiated over the course of time. Their primary reason, maybe I'm just being paranoid about this, is really to help the businesses do business cross-border, and we're the secondary thoughts. But the UK and the Canadian double taxation treaties have proved that the State Department can start to think about us as individuals. So hopefully, knock on wood, we'll be in a better place by the time we get to retirement.
And I would agree with that. I mean, the answer is always going to change, just kind of depending upon the final country combination you're looking at, because the treaties are different. But it's generally best to plan for, giving yourself the most flexibility, and a Roth would do that. The other country may not recognize it as a tax-free distribution, but there are a lot of treaties out there that essentially do say that the country of residence gets the same tax treatment as you would get in the country of source. So which meaning that, and I know the UK treaty has that language specifically in there. So, if you were, if it was a non-taxable distribution in the US, then the foreign country respects that same tax treatment. So going the Roth route kind of always gives you more flexibility.
Perfect. So it might come down to you have to take a 1-year sabbatical between work and retirement to go ahead and liquidate some of your pensions to get the best tax treatment, but that's a problem for down the road, not today.
Well, and one thing, Brian, we haven't mentioned or talked about at all is state taxation. So one of the joys of the US is there's federal taxation, there's state taxation, and then a lot of locations even have city or locality taxation. So the potential state is something you always want to look at as well. And again, every state's got their own set of rules. Some states allow the foreign earned income exclusion, some don't. Some allow foreign tax credits, others don't. If you may say, oh, well, I'm gonna wait until I leave the Netherlands and takes my distribution, but you moved to New York City or California, and then you took that distribution. Well, you just added on an additional 10%. That may not actually be a better answer than if you had stayed in the Netherlands. So you always want to look at kind of both federally and the state what the potential implications are.
That's a great point. We only have, I think, 7 states left that don't have a state income tax. So odds are you're probably in that place that you need to compare.
And I've had a lot of
apples.
clients that either for while, or, you know, before you establish residency somewhere, it's that you go on a prolonged vacation, you break Dutch taxation, you take all of your distributions, avoid the state taxes, and then you establish state residency somewhere. It's either you can do that via a prolonged vacation, maybe you establish residency in Texas or Florida for a little while. That's kind of the two, you know, renowned tax-free states because they have nice weather. So that there's ways to plan around it, but you just got to make sure that you address it up front rather than after the fact.
Absolutely, a good financial plan always helps, you know, going down the road. So, Corey is having to actually step away, so he's going to be watching the recording. So just to remind you all, we are going to be sending out the YouTube with the full recording of everything, and it will have Shannon's information and such, so that you can go back into some of these. But he had some subsequent questions. Even if the investments go down, you'd have to pay taxes on it to the Dutch, which is the wealth tax portion. It's just factored in a different way. And now this is where I'll dork out as an economist. It's a much more efficient system because the tax is based on a view that you should be making, say, 4% per annum in anything that you're owning. Now that means you're paying a portion of that in tax every single year, whether the account goes up or down, instead of a capital gains tax, averaging out each and every individual year. You typically will pay a little bit less tax over the course of time, but you'll probably have less tax inside of your bank account. You might talk to your banker and they might find ways to keep those cash balances at a minimum by using some exotic vehicles. And I don't want to usurp the tax conversation and go too deep into those, but very pragmatic ways if you have a American and a non-American in a couple. So yes, we're up to yep. So that's just the understanding on that. Sorry, Nick, if you drop me an email, I'd be happy to send you some of the different providers that are good for different places and minimums, because it depends on different situations. How are U.S. assets? Are U.S. held assets treated by the Dutch estate tax law for U.S. pensioners living in the Netherlands? Well, you're going to be, sorry, do you want to start on this, Shannon, or should I dig into that?
Yeah, no, go ahead. Go ahead.
So U.S. held assets, you're gonna fall into 2 aspects. The Netherlands is going to consider all your global assets to be taxable, so it's not hiding it from estate taxes in any way, shape, or form. On the U.S. side, you need to make sure that you're structuring it correctly, because if it's going to a non-American, let's just say you're an American, you give it to a non-American spouse, all of a sudden you could get hit with a potential tax because you only have the 60,000 exemption on those types of filings. You can do a post-mortem QEF, trust, to where it only gets taxed after your spouse passes away, but it is something that you really want to dig into if it's a non-American spouse. If it's to another American spouse, essentially right now you have an $11.7 million exemption in the US. By 2025, it will definitely drop down to the 5.5 million range. But Biden and Bernie Sanders have a potential proposal to bring it down to 3 or 3.5. If it does go down to 3 or 3.5, the main thing that you'll want to think about is whether you start using some of the gift tax exemptions beforehand, before that disappears. I don't know if you have anything to add to the gifting type of regimes.
No, probably just one thing is so yeah, there's no limitation on gifts between U.S. citizen spouses. So as Brian mentioned, if I'm giving to a non-citizen spouse, you get the 60. You know, there is an annual limitation on that. I think non-citizen spouses. So the estate transfer to a regular foreign person is 60. Well, for a foreign national, 60,000. If I'm giving to a non-U.S. spouse, I can give up to 150,000 a year. But for transfer between both US citizen spouses, there's no limitations at all.
Perfect.
The $11 million comes into play when I'm giving assets to like typically like children, niece and nephew, whatever that is, when I'm passing it down in the generations. Yeah, and as Brian kind of alluded to, that's a big area we're going to want to keep our eyes on. There's lots of proposals around there of what's going to happen with the estate taxes. The current laws are good through 2025. So, and then everything sunsets. So even if nothing happens, we're going to drop from the 11 million back down to, I believe it's 5.5. There is a proposal to potentially bring it down to 3.5. The way the politics work is we've got two opposite sides. They basically each throw out as a proposal their best case scenario, and then the negotiating starts. So I know there was a lot of really scary things, well, at least from a tax perspective, my viewpoint in the Biden, because they were talking about greatly reducing the estate tax exemptions, eliminating step up in basis upon death, which would be a huge impact. So that's kind of the starting point. I think the big piece we got to see is where are we going to end up at as compromised middle ground. Some of that'll go through, some of it's going to get adjusted.
Brilliant. That it is one of those. The only time that I would be sitting there looking at bigger gifting strategies is if all of a sudden you're wanting to build a multi-generational strategy, and that is to where you can use some of those gift tax exemptions to get it in front of these issues and move forward with them. We have a question here. Now, this I'm halfway leaning towards it probably should be for a Dutch accountant, but I'm going to ask it to you anyways, and feel free to just bypass it. How is it possible to be paid for contracting work by U.S. companies, small amounts less than $3,000 US?
And then they're curious what it's going to mean in the Dutch taxes, or
that's the entire question.
That's the entire question. So from a U.S. perspective, again, it doesn't, you're going to be taxable on it, kind of regardless of amount. Technically, if you're over $600, they should be issuing you a 1099, actually reporting that income to you. So if you get any 1099s, you're absolutely going to have to report that income for matching purposes. But generally, any income that you get paid to you, regardless of source, is going to be taxable.
He's saying he can be paid either in the U.S. or a Netherlands account, but I'm not sure which is better to do so. I think this is more of a question for a Dutch accountant than Shannon. So I'm not trying to divert it off there. I just don't want Shannon to give advice that he might regret because of being the expert on the U.S. side.
Okay. Yeah, from a U.S. perspective, it's not going to matter. It's probably whichever account is more convenient for the cash transfers. But
exactly. I just got a question. What are the best options for investments outside employer pensions for U.S. expats? Should be repatriated our euros back to the U.S. and invest in the U.S. So our company, Dunhill Financial, we have providers that work both here in Europe and over in the United States. So we can build accounts in euros or in US dollars. It's a little cheaper for you to do it in US dollars than euros, and yet we build the exact same portfolios. So it becomes a moot issue if we're doing something that's more like a monthly accumulation plan where we're using a service like TransferWise or N26 to where we can transfer money into different currencies for free. If we're doing larger amounts, all of a sudden changing currencies can become a little bit more costly. So it depends on each situation in those parameters. But if you go to dunhillfinancial.com, we have more information about it. And otherwise, if you drop me an email afterwards, I'd be more than happy to schedule a phone call to discuss the different plans that we have. This one's perfect. What kind of tax planning would you suggest doing prior to moving to the Netherlands, both spouses and kids are US citizens?
Yeah, big thing is setting up your accounts and where you're going to hold all of your assets at. And one of the unfortunate things is it's not very convenient to get money between the U.S. and Europe. Even if you've got an account at the same bank, you can't just transfer it like I can between my checking and savings account, where I go in and do the simple online transfer and I'm done in 2 seconds. So probably a big piece is just kind of setting up how you want to do your kind of broader banking and investment structure. Again, investments, my high suggestion is to just always leave your investment accounts in the US. It will make your life 1,000 times easier. You're going to need bank accounts in the Netherlands, but keep it to checking and savings. Cash accounts, a CD is also okay. But if you keep it as cash-based accounts, you're not going to have any problems. In terms of tax planning, there's not as much consequences when you're the U.S. citizen moving abroad, because your taxation from a U.S. perspective is not going to end up changing. You get taxed the same. You're always subject to taxation. So it would probably be the bigger considerations is what you're going to have from a Netherlands perspective, and even there, it's not going to be huge implications because the Netherlands, stuff is still going to fall into the wealth tax.
I'll add a few things from the financial planning vantage point before you move over to the Netherlands. You want to think about, first of all, if you're going to use your U.S. credit cards, be careful using them in Europe, because the currency is going to be could be a killer on those different rates. So you might be getting yourself a 1% in points, but it might be costing you 3% on the currency differential. So I would definitely look at setting up something in local euros before you get there. Most of the banks might be hard to open a bank account before you get there. Use a service like TransferWise or such, where you can have multiple baskets of currencies and you can have your debit card taking out of those currencies to save you money. These are great technologies. They're not perfect at substituting a bank, but they can help bridge the way over. If you're going to go back to the States at some point in time, think about your credit score back in the United States, i.e., don't cancel all your credit cards, et cetera, to where you go back 5 years later, you find that you have absolutely no credit score in the United States because they see that you've disappeared. But make sure that you don't stick all of your investment accounts, all your bank accounts, et cetera, in one of those 43 states that has a state income tax. The two that are notorious for going after you are New York and California. You leave an investment account, now Shannon's going to get a 1099 saying you've got income at an address in California. California sends you a letter saying, hey, we got this document from a brokerage stating that you live in California. Why didn't you file taxes? Why didn't you pay us? So be careful of where you strategize leaving those statements going to. Naturally, better to work with a brokerage that can actually change your address to the Netherlands, of which we work with plenty. But those are just a few subsequent things. Jan, I'm sorry, I'm actually gonna avoid that question just because it's very personal. I'd be more than happy to have a conversation with you about it offline. And I know Shannon would be as well, but I don't want to go into your personal details on here, so my apologies there. With that being said, we've actually gone through all the questions, Shannon. So
okay,
I'm gonna ask you the important question that has no answer. Removing politics from it, where do you think these Biden tax changes are going to go for the year?
Yeah, so I think there will be something that comes. I mean, that's kind of the inevitable with taxes is that they will not leave the system alone. And I know in the media and they will all talk about that it's going to be simplifying, and that's what all of the Congress and president will say. I have yet to ever see a tax change that simplified anything. So that's probably just the general caveat.
So, somebody told me that the tax law is 75% of the U.S. law code. I don't know if that's true, but I heard that.
I would be surprised because It's massive. I mean, the amount of tax code books we have compared to what other countries get by is kind of astonishing. But they will. I mean, the two big areas that they're hitting at is changing the individual tax rates. I'm expecting that those will go back up. What'll be interesting is if they change the cap on state tax deductions and real estate taxes. So if you're if you claim itemized deductions, you can take a deduction for your state income taxes paid or sales tax, kind of the greater of those two, and real estate taxes paid. It used to be you could take a deduction for whatever amount you paid. So if I'm paying $100,000 between state income taxes and real estate taxes, I get a $100,000 deduction. With the Trump tax reform, they put a cap on that where you can only deduct up to $10,000. So kind of the wrinkle that probably a lot of people didn't see is, or at least until you were in it after the fact, that they reduced the tax rates by roughly 3%. But then they put in this tax cap on the state tax deductions for itemized that ended up having about a 3% tax rate effect. So it was if you were in a higher tax rate state, which is most of the coasts, you kind of ended up getting back to the same spot. New York, you actually probably had an increase in tax liability, even though the tax rates got reduced. So that'll be the interesting thing is if they increase the tax rates, what are they going to do with that state tax deduction? Probably got less of an impact of everybody living in the Netherlands, unless you continue to be treated as a resident of a state somewhere.
Herman has a follow-up that I think is great. What are the chances that the capital gains tax is raised?
That's been the other big proposal that they want to make that ordinary income, and that's going to be one I think that will get heavily fought out in Congress, because that's got a pretty massive effect on everything. I mean, that'll affect the stock market. You know, my personal viewpoint is I think there should be some motivation. I like the concept that we motivate our people to save money. If you start taxing everything as ordinary income, they're stripping out all of the motivations to save. It's a little bit the same issue with the inheritance tax. Is if I'm going to tax everything when it transfers, they're eliminating all of the motivations to ever save and try to pass something on.
But actually, I'll dig into that because it's one of the topics that poor Kim's working on for our economic update that's coming up at the end of June, and I'm just going to go ahead and ruin the surprise right here. One of the sections that we're talking about is exactly that. What happens, or what has historically happened when we get increases to taxes, and how does that affect the stock market? Should that scare away the stock market? We've had 3 periods where we've had tax increases in the last 4 decades. And every time the same things has happened. The first couple of weeks, essentially, the stock market goes down. Within 6 months, we fully recovered and gone back on the same trajectory that we were at before the tax increase was put into place. So the S&P is fine. But the main thing is, the main correlation on each of these issues was that the past year's biggest momentum plays have actually underperformed the S&P 500. So now, if we put that into context, if you're just invested in a diversified mix and you're just buying the S&P 500, the MSCI Global, etc., essentially past tax increases have been a moot point to you as an investor. If you did what most people did last year and you bought a heavier amount of technology stocks, e-commerce stocks, etc., that would historically show that they should underperform after that tax increase happens, which naturally would be because those will hit them the most. They were the ones that have the biggest tax impact.
And on the Brian, on those tax increases, were you looking, is that just changes in ordinary rates or specifically on capital gains tax rates?
I believe it's ordinary rates, but I'm going to have to ask that question to our analyst, to Cam. I'll expect you to ask that question on our economic update so that I have the answer for you. But I don't think we've had 3 capital gains tax increases in the
Well,
last 4 decades.
that's the reason I asked that.
That's the only reason I'm leaning towards the
changing in the
earned
capital gains is a lot more uncommon.
Absolutely. So I'm making a guess, but I'll definitely have an answer for you on that at the end of June.
Yeah. Well, and the other thing that I tend to see happen is the stock market tends to react to the upfront proposals, and it's more like on fear and less on fact. So so typically, if the market's going to take a cut, because we already saw it when they made the original announcement or proposals, hey, we may tax it, the market took a big drop. But then later on, when it actually comes into play, the market's already kind of taken its correction, and it doesn't really phase it later on. So
absolutely. We're going to take one last question from Albert, and then we're going to have to sign off. I love how he positions it. I'm almost afraid to say it, but cryptocurrency. Today, China put a big ban on cryptocurrencies, a secondary ban. So how can U.S. citizens in the Netherlands declare it either in the U.S. or the Netherlands? Really, I think most of the crypto, we'll go into, you can read those opinions because it's off to everybody. But can you declare cryptocurrencies in the United States on their taxes?
Yeah. So crypto is kind of this new weird monster that the IRS is trying to figure out how to deal with. But essentially, kind of, it's considered a personal asset, not an investment asset, but they effectively end up kind of taxing it the same. So, but what that does mean is it's not an investment or an asset that's required to be tracked by like the brokerage houses. So you're dealing kind of with the tracking, reporting of it on your own. Now you do have to, just like everything, when you buy it, you've got basis in it. When you sell it, you've got proceeds, and you're recognizing the gain or loss on those transactions. You can also get ordinary income, and even if it's not really treated like money yet either, but it's really just a personal asset. So if you use a cryptocurrency to pay for something, to buy a good, that's treated as basically like a distribution of that cryptocurrency, and you got a gain or loss transaction on that event. My suggestion is there's a couple of, to make your life a lot easier and your accountants, is to sign up with one of the services that tracks it. So I know there's Coinbase that will monitor all your transactions, and then Coin Tracker is the software or like a vendor that will monitor and keep track of all your bases. Because part of the struggle with cryptocurrencies is it's not like a real clean, I bought 100 shares and then I sold 100 shares. It's usually like I bought 0.01 of this, 0.0, I'm buying it all the time, and then I sold it in a block. And so being able to get them to match up the gains and losses for the transactions gets to be pretty tough. There's services out there that will track all of that for you, and they're gonna, that's at a much more cost-effective rate than the CPA is going to charge you to monitor all that basis.
That's brilliant. We talked about cryptocurrencies and how to be a part of it without owning cryptocurrencies. In other words, buying into companies that trade those cryptocurrencies and are making money, whether cryptocurrencies go up and down. PayPal, MasterCard have both built big units to do that. I like those types of plays if you want to get into cryptocurrency a little bit better. Just more on the analogy of Levi Strauss. We still remember who he is, but we don't remember who any of the gold miners were. Cryptocurrencies, I still don't see them as an investment. I'm not saying that they're going to fail or anything else, but it is a speculative nature based on whether the government will allow us to use them. Like I said, we had this big news from China today, which is trying to remove them completely from their system. We saw that from South Korea. We've seen it from other countries in the past. Essentially, we don't want to speculate in our retirement portfolios. With that, we have run out of time. Shannon, always wonderful to see you. We will be sending out a follow-up email with all of your information, but can you give us how to contact you, who should contact you, etc.?
Okay, yeah, so I'm happy to help with follow-up questions, or if you've got personal ones that we need to dig into a little bit more, happy to do that. Easiest is either to send me an email or give me a call. I'm perfectly fine with either. And probably the simplest is, yeah, Brian can circulate my contact information to everybody, so we've all got it written down.
Wonderful. Thanks so much, Shannon. Thank you everyone for joining us. And we will see you in 3 months for the next edition. In the meantime, please stay safe.
All right. Take care, everyone.